All right, so in this video, I'm going to talk a little bit about some variable life insurance policy characteristics. So for variable life insurance policy, basically what happens is the policy owner chooses investment options for the cash value. So basically, as the cash value is accumulating over time, it's actually being invested. But in this case, the policy owner gets to choose what it is invested in. Now, typically, this is going to be um, a situation in which those choices are limited to a menu of options. But the idea is that the policy owner does get to choose among those options what the money is invested in. And that means that the final policy value will depend on how those investments do. So what the investment choices are, how the investments perform, will affect the final policy value. So if you're thinking about this is kind of starting to sound a little bit more like a almost like a retirement account a little bit. And then you're saving money or investing money that is going into options for investment. So something like mutual funds, that kind of thing. So if it's sounding a little bit like a retirement fund or retirement account, hold that thought because we're gonna come back to that in a moment. Now, if you're thinking about the bigger picture for this, what that means is now the insurance company has underwriting expenses, but they also have investment expenses because they are actually sort of running these investment options. So the fees overall for variable life insurance policy are going to come from those underwriting expenses and the investment expenses. So typically this means that fees as a whole for variable life insurance policy are going to be higher. And it might be higher than if you bought separate insurance. And if you wanted an investment piece, just invested your money through, say, retirement accounts through actual investment accounts and use low-cost index funds or index mutual funds or something like that. So it's something to kind of evaluate there, whether this really provides the combination you're looking for or what the effect of those fees really is, and whether maybe the fees are too high or maybe the fees are appropriate and reasonable relative to the investment options you have and so forth. Now, in order for it to be a life insurance policy, there is some level of guaranteed death benefit. So in that case, basically what that means is even if the investments do very poorly, there is at least some guaranteed level of death benefit. So that kind of brings us to an interesting application here, and that's the variable universal life insurance policies. So for the variable universal life insurance policies, we have sort of this variable piece, and so we're kind of combining this investment with insurance, and that opens up an interesting scenario, and that is that it is possible to, in effect, sort of fund the policy early, so kind of pay for it faster, and then you're sort of you've accumulated money that is then going to be invested and then hopefully grows, and then you have more time for your money to grow. So it is possible to essentially do early funding for a variable universal life insurance policy. However, if you fund the policy too fast, it can actually trigger a modified endowment contract rules regarding loans or withdrawals. So basically, kind of what's happening here is that if you funded that policy super fast, then you're doing is you're sticking a whole bunch of money into this policy in order to invest because it's a variable life policy, and so a significant portion of the money is going towards being invested. And as a result of that, if you've done this all in one lump sum, well, it kind of looks like you're just trying to stick more money in a tax advantage investment account. So, which is kind of what people would be doing. And so as a result of that, there are rules that basically limit what can be done and how things are treated for loans taken against those policies or withdrawals from those policies if the funding was too fast. And so if it looks like you're basically trying to create an extra way of saving in a tax advantage manner to the government, so if that's what the government's perception of the situation is based on how fast you were funding this, then it triggers these additional rules. So that would be something to watch out for if you were thinking of, well, I'll just pile a whole bunch of money into a variable life insurance policy and then invest it and I can get extra tax advantage savings. Well, you can fund early, but if you fund it too fast, it's going to put in place some limitations on that policy. And so that's something you'd have to be very, very careful about. Okay, hopefully this video about variable life insurance has been helpful. Thank you for watching. Have a great day.